Thank you so much for your time on the show today, Sam. Let's start with a look at the markets and how they're performing today. What's your take on what we saw yesterday? What saw play out yesterday in the equity space, where we saw the market, fail to continue the momentum we've seen in the past weeks?
Yeah, thanks, Ken, and thanks for having me. So basically, the market was bound to, at some point, begin to have a rebound based on what we had seen. Yeah, let's not forget that the reason we've seen this rebound in the equities market is because of what's happening in the fixed income and money markets, where rates have gone down considerably, and people are looking for where to put, where to create quality assets. And so you've seen an upswing in the all-share index of the Nigerian Stock Exchange to over 34,000. I mean, it's been the best we've seen since 2018. But however, it was meant to stop at some point, because remember that traders are not oblivious of the fact that fundamentally, you've got to be sure that the stocks you're putting money in can sustain the momentum and the pricing based on your fundamental analysis. So this was expected.
Expected, you say, but let's look at what is going to play out today with the bond auctions, and that's expected to happen today on tomorrow. Sorry, when the DMO comes to the market. What do you expect with subscription rates?
So as it's been in the recent past, we expect that it will be oversubscribed. We expect that what DMO will be doing tomorrow will be oversubscribed as usual, because again, people are looking for where to put. There's a lot of liquidity in the market. And what people are doing on both sides, whether it's the equities or the fixed income side, is where to front load this liquidity that is in the market. So our expectation is that it will be subscribed, but we also expect that DMO in their usual manner will take what they have offered into the market and not take the oversubscription again, because I think that at the current levels, the government is happier at borrowing at single digit. You can imagine 1 year money at less than 1%, and you're getting 30-year money at less than 5%. So, I mean, that's a good place to be. So why do you want to trigger that market and change such yields that you see today?
All right, but let's go back to the equities. Looking at the performance so far, I'm sure nobody saw that at a time like this, even in the middle of a pandemic, that the markets will go up as high as almost 30%. But for you, though, do you see this winning out anytime soon?
Not as long as the what is happening in the fixed income market continues. As long as you have those kind of levels in terms of yields that we see in the fixed income market, investors, asset managers, bulge investors, and people who are playing for their books would always look for where to find a bargain. So when you begin to see the equities give you a very good dividend yield, just not even capital appreciation, if at current levels you're getting a dividend yield that is much higher than what you will get from the fixed income space, then it's no brainer that you will go there. Also, add into the mix that inflation is on its way up. So as much as you invest in the fixed income space, what you're getting is a negative return in real terms, judged by inflation. But the equities market has the capacity to give you a good dividend yield that is much higher than what you're getting from bonds right now, and also possibly give you a capital appreciation that helps you to correct inflationary pressure. So I do not think that the market will run away. If the market runs away, then maybe we'll have another bubble. But I think that these levels will be sustained for a while.
But on the equities front, though, when you look at the sectors, which are more attractive to investors at this time?
So you would see from what's been happening in the markets that the banking sector is still very hot. And so people are really trading on the banking stock, especially the tier one banks. Also, the fast-moving consumer goods have not done badly, and there's still a lot of interest in that place. And then I noticed also that a lot of traders are interested in companies that have investments in diverse spheres of the economy. So you've seen what has happened with Transcorp, and you see the kind of trades in terms of volume of trades that we've seen in Transcorp is because of the diversified nature of the Transcorp portfolio. And then also people are taking a bet that certain industries will not be as hard hit going forward. Because remember that during the lockdown, there were industries that were more affected by others. So the bet is that there will be some recovery. Even if you look at what's happening with the hotels and people in lifestyle, companies in lifestyle, you would expect that there should be some form of pickup because post-lockdown, business activities are picking up again and people are traveling more again. And when you travel, you've got to stay in hotels. So hospitality is going to come back. However, we hope we don't experience another lockdown.
All right, but looking at the investment environment, we're seeing inflation at 14% from the latest reading from the National Bureau of Statistics, though. But how does this play for in decision making for investors?
So, I mean, it's a tough one for investors at this point. You have inflation at 14.2%. You have yields from government securities, treasury bills at less than 0.5%. You have maturities in the bond market trading at less than 5%. So you can have as much as 14% negative return or 13.75 negative return or 10% negative return in real terms if you adjust for inflation. So I think that this is a time when investors will have to find a way of balancing their books. And that's why what's happening in the equities market is happening. But again, in a market like this is the time to look forward to quality investments that gives you a return over time. I think that one of the things that has to happen with our markets is that this rush for short-term returns would have to turn around. I mean, in some clients, PFAs invest long-term in companies. They take a company from a certain level, invest over a 5-year period, and exit like a PE type investment. I think our PFAs should begin to do those kind of investments, and this is time to begin to look for such investments that could give you very much double-digit return that balances your portfolio. So quick wins are going to be difficult to find right now.